Welcome to week 25 of 7. And today we're going to talk through a strategic case study. The reason why I'm calling it strategic, this is a case study. It is an actual business. It's one of the fledglings. This case showed up on one of my office hour calls about 2 weeks ago. And this is the same talk that I did for Fledge 16 and a bunch of other entrepreneurs this morning. And the reason I did it for them is because the structure I'm going to show you, the analysis that I do and given an opportunity like this, is mostly focused on spreadsheets. There's a lot of ways to analyze companies. There's sometimes what's most important is to focus on the product and go deep on what the product is, what the experience of the customer is. Sometimes what's most important is the sales effort. What's that sales funnel look like? How hard is that? But what I found is that more often than not, the numbers make or break the idea, right? That the numbers will tell you, if you put them in the right order, whether or not this opportunity that sits in front of you is the right idea or not. And so this entrepreneur got on a call with me, told me there was a new opportunity, explained what it was, and we spent 15, 20 minutes, with me there sharing screen and an Excel spreadsheet, starting with the Excel they sent me, but editing it and turning it into really the answer on the opportunity. So I'm going to walk you through that. And then at the end, I'm going to ask you whether or not we should take the opportunity. So we start here with some actuals. So I was sent 2 spreadsheets. The first spreadsheet was actuals from January through July, but what I'm showing you here on the screen is just January through June on purpose. It's been scrubbed a bit. This isn't exactly the actuals of this company. Some of the numbers have been rounded. Everything's been turned into dollars. This is a company from the emerging markets. So these are reasonable numbers. These are not tiny little numbers. And it starts at the top. And so just a recap on how to read a financial report, right? This should look familiar as a P&L. We've talked about that many times before. And so you start at the top. And unlike the P&Ls that the accountants give you, P&Ls that are sent to me start with units. So January, this company sold 12,500 kilograms of product. I'm not going to talk about what sizes they sell. We're not going to talk about what the product is. They successfully sold 12,500 kilograms of that product in January. And they were paid 65 cents a kilogram. So commodity product. And so the total gross revenues, and the way this works in terms of coloring, this is my standard coloring. If it's blue, it's a number that's typed in. If it's black, it's a number that's calculated with a formula. And we're looking at a PowerPoint slide, so I can't show you the formula, but this one's pretty easy. It's this number times this number gives you this number. Right? So in January, this company earned $8,125. And we can kind of glance over to the right and see February was the same. Okay, jumping down a bit, the next section is how much did it cost us to sell that product? How much was the value of those products and the packaging and whatnot? And so we're repeating 12,500. It's not blue, it's black because it's just this number repeated. And the reason we have it separated is, maybe 1 month, which they're all black, so it didn't happen, but maybe 1 month we bought 15,000 kilograms, but we only sold 12,500 and we have an inventory. I use cash accounting, which means we don't have any place else to put inventory. It would show up there. But no, we did exactly the same purchases we sold. We cost us 25 cents per kilogram to acquire this material. We spent 6 cents on packaging per kilogram. That's per kilogram. And so our total cost of goods was $3,875. And then operating profit, what I like to call net revenues, but it has a bunch of names. In Africa and elsewhere, they often call it operating profit, is just this number minus this number. And so we have 4,250. And when it's sent to me, it rarely ever has the margins calculated. That's almost always the first thing I plug in. So let's plug it in. Gross margins is just operating profit divided by gross revenues. And we see 52%, which is pretty high for a food product. This is a food product. All right. So we have 52% of all the revenues to run the company. And if we scroll down, you can see we have salaries and utilities and rent and transport and miscellaneous. They're all in blue. We'll just assume those are correct. There was $3,700 worth of expenses. And then we get a net income that's positive, which is a good sign. Not a ton of money. Not a whole lot of spare money lying around in this company. But positive numbers good. All right. And then this, just be clear, is operating profit minus expenses. All right. And then we can start looking over to the right, and we can see that the revenues were the same. Cost of goods went up a teeny bit. Gross margins were about the same. Expenses went up a bit. Broke even in February. Then there was a pandemic, if you haven't heard. So March was down, April was down more, and there were some losses, right? And then it picked back up in May, but it didn't just pick up to where it was. It picked up more than it was in January and February. That's the good news. And then I can't see June because it's hiding behind my face here. And in June, it picked up again. It got even bigger. We got paid more. Or sorry, we lost some revenue, or we got paid back to what we were being paid before. But revenues are way up, $22,000 for the month. And again, these are actuals. This is more or less what happened to this company. And they bought enough stuff, and we can see that the price came down a little bit from the middle months, up back to where it was in January. And margins are back to where they were in January, and expenses are up, but profits are way up. So we're doing good. So we did $60,000 of business in the first half of the year, right? Nothing to write home about. No record-winning company here, but not bad. And it made money for the first half of the year, despite the pandemic. That's in 2020, we consider that a huge win, right? Companies that are making money. All right, and if we scroll down a bit, same spreadsheet, we just scroll down to show the bottom. Normally, this is the bottom line. Normally, this is the last line of a P&L, but in my system, we continue to show more things below that. So one thing that is normal is to compute the net margins. They just didn't fit on the screen. And so net margins are just the net income loss divided by the total revenues. And so you can see it was running really, really skinny in the first few months. 7% is not high margins. 1% is terrible. Negative is bad, but we're up to 21%. So when I saw this, I said, okay, so maybe this company needs to earn about $20,000 a month to be a real company. Anything smaller than that, there's just too much overhead running the company. Don't know. Maybe the net margins will go up as the company gets bigger. Don't know. Well, we can see here the next block is things that we're paying for that last more than a month, right? Big expensive equipment like trucks. And the only thing we have listed here is a truck. So bought a truck in January. Had we pay for a truck? It's in the last block here. The last block is investment income and payments back out to investors. It's really the flow of capital to and from investors. So there was a $30,000 investment. There's a rev share attached here. This is not real. I'm just showing this because this is where it goes in my system. And then we have net cash, which is net income minus what we spent on capital, plus whatever the net was on the investment capital. And the very, very bottom line, we see how much money's in the bank. So assuming there was $2,500 at the end of last year, you add this to this number, you get 7,700, and then you just keep running total. So this is just, column D is just column C plus the change from column D and onward. And then the last one is just pulled over from June. So company has money. If it runs out of money, then I get a call saying, Looney, we're out of money. We need more money. Hate to see that happen. Not a good sign. So we're always trying to tell the entrepreneurs, keep that number positive, and ideally as we all learned from 2020, keep a few months of expenses sitting in the bank. Like if your total, if we'll just scroll back a bit, if we know we're spending $3,500, $4,000, now $7,000 a month in expenses, it's good to have a few of those months sitting in the bank as cash. That makes life much easier. And we have 1 month's worth of cash in the bank right now, which is better than nothing, but not great.
Looney, can I interrupt with a question?
Always, yes, please.
Okay, so if we scroll back up to where it says fixed expenses, I've got a problem with transport being a fixed expense.
Yeah. So just be clear, I hear you. So this is one of those cases where it's debatable where you stick it. Is it a cost of good or is it a monthly expense? The way in the end, it doesn't matter. In the end, it moves the margins from either the gross margins to the net margins, but then the total number at the bottom comes out to be the same. And the reason why transport generally winds up being in fixed expenses is the definition I tell them for cost of goods is if you sell 1 more kilogram, it goes there. If you sell 1 more unit, it goes in the cost of goods. And if it's fixed, no matter whether you sell 1 more or not, it goes in fixed expenses. And the reality is you have to pay the truck driver to drive the truck. And we're generally not filling up a whole truck. So 1 more kilogram doesn't change the cost of goods.
Okay, so I'm with you, and I don't do it as 1 more kilogram. I do it as a significant thing that varies with the volume you have. Fixed expense shouldn't vary with volume, and yeah, your utilities are going up and down. Those fixed expenses, I don't have a problem with that because it's reasonable. But when you go from $665 to $2,800, a factor of 4 in terms of a fixed expense from month to month, it no longer can be a fixed expense. It's
I hear you. I often call these operational expenses instead of fixed as well.
Okay, well,
and it's almost and we're talking about emerging markets. It's 90% fuel, right?
Okay,
so the salaries don't cost much anything. It's a fuel charge.
Okay.
And so again, like if you're calculating this on a, this is monthly, so it's not too bad. But this means, well, what happens if we're filling up the truck once a week with fuel or every 4 days, and the fuel runs into next month? Like, are you going to try and calculate this down to the accurate month or the accurate day?
No. This is a cash flow statement, and so you do the same thing as if you had ended up with inventory because you purchased X number of kilograms more than you actually sold. It's all the same thing. It's a cash flow, but okay. I'm with you. I'm not gonna. It's just a different way of putting together the spreadsheet.
Yeah, I hear you.
I see the margin being a problem here in this thing, and because that would change the margin.
Yeah, it'll lower the gross margins, but the net margins come out the same.
Yeah. Okay.
I hear you. It's a good one. I would say this is once I get all the fledglings to the point where I can get a report like this once a month, that would be the next thing I would nitpick. At the moment, okay. I would love to see this level of detail and the margins visible and everything else making sense. If I had that, I would be in nirvana.
Okay, fair enough.
But you're right. Right, you're right, and there's more nitpicky to go on there because some of that salary probably is labor up in the top, and
okay,
but we'll get there someday. All right, so question 1. I think there are 3 or 4 questions in this case study. Question 1: how strong is the company? Like, how do you sit there and analyze and say, is this a good company? Is it a bad company? Are they doing well? Are they doing poorly? Again, this is what I'm showing the entrepreneurs in terms of what investors look at and bankers look at. And again, I'm open to questions and comments. And ideally, it's great if you have a different opinion. But the first place I look is the revenue line. So just looking at the revenues, well, there's a dip. It's a pandemic. I'm expecting dips. This is nice and promising. It's growing. So this was flat for whatever reason. Maybe it's seasonal. Maybe what they're selling, it has a season to it. And January, February is the slow time. It would be nice if I had last year's numbers, but I don't at this point. But 12,000 is bigger than 8, and 22 is much bigger than 12. So this is promising. I like that. I like the fact that the price is pretty steady. Right, the price we're getting is pretty steady. I look at the gross margins. Yeah, debating whether or not they're accurate or not, but at least again, they're in the low 50s, and they're in the low 50s again, and high 40s. So, steady is good. Slowly going up is good. Dropping down to 25 is bad. Right? But again, we had an excuse for April. Excuses are good. Right? Average for half a year was 45. That's not bad. Looking at the net. Okay, we had 2 bad months, but the rest of them were okay. The sum total for the half year was positive. That's a good sign. Net margins, the same basic story. If I had more data, I would be questioning this entrepreneur saying, Do you understand that you're running a business on less than 10% margins? Is this an anomaly, or is this the new reality? Let's actually teach you what net margins are and maybe make it a KPI of your company, so that you can understand that if you're running this lean, you better be cutting the expenses somewhere. That you can't be running -6 for the year. You got to be running positive for the year. And then at the bottom is net cash, and it's there's money in the bank. That's a good sign. They didn't run out, but the thing that I noticed of this was they were like, in April, they were 2 months away from closing their door, asking for more money. And the good news in these kind of companies, when they're young and small, we can fill in this gap, right? We can provide them $10,000 more. We gave them 20. We can give them $10,000 more if that's the difference between falling apart in a pandemic and staying around. When this is a bigger company and you add a 0 to this or 2 zeros to this, then we're in trouble. Then we have trouble finding the bridge capital. But the numbers stayed positive, so not a bad business. And we have more money now than we had at the beginning of the year. We had more money at the end of June, just to be specific, than we had at the beginning of the year. That's a good sign. All right, then the question comes, like, if we were going to invest in this company, which we haven't done, we haven't done again in Africa Eats or in Aviary. If we were to invest again, how big would we say this company is? And this is an interesting question to ask. So given only a half a year's data, and we'll just assume they were doing 8,000 a month all of last year. Just take that as a random assumption. It's more or less accurate. So here we have the gross revenue line, and it adds up to 60. And so we could assume here in August, we could, of course, or September now, we could ask them for new numbers, and I'll show you those in a minute. But if this were July 1st and we just got these numbers, we could say this company is doing $120,000 run rate. So 60 for half a year, multiply by 2, right? That's not going to be accurate because there's a pandemic drop in there and there's some growth in there. Like, it should just be clear. If we're looking at 60, 22 of that, a third of that was June. But one way to say that how big this company is to just take their half year revenues, multiply by 2, or the last quarter and multiply by 4, and say that's their run rate. So it's totally reasonable to say this company had a $120,000 run rate for the first half of the year. And assume that a reasonable prediction was that by the end of the year, the company would do at least 120, hopefully more, given the growth in June. But we just don't have enough data to know if June was accurate. And the other question to have along here is, well, is this company growing fast? Is it, because it's kind of noisy data. So how fast is the company growing? All right, well, here we have July and August to help us answer that question. So January through June is exactly the same data. And then we got data for July. And just be clear, July is real, August is made up, right? I did this call in August, so we didn't have this, but it makes a better case study. So I'm running with this. I think August will, in fact, look like this. I'll find out in a few days. All right, so here we have July was more than double June. And so I did talk to the entrepreneur and explain that doubling is an impressive thing to do and a really stressful thing to do. Don't expect to keep doubling every month. That's a crazy growth rate. And so August just going up a teeny bit is a reasonable thing to do. Same price, and now we have way more revenue coming in. Same thing, we bought the same stuff that we sold. All the cost of goods are the same. And so the cost of goods are relatively the same, and we have the same margins. And so seriously, the margins were the same in June and July. We'll just assume they run through August like that. And the salaries and the rest of the expenses jumped up, and I'm not going to show that. And so now, when we add up the first 8 months of the year, we get 166. Which, just be clear, is bigger than 120. Like we just did $100,000 worth of business, and we said this company was 120,000 run rate. So that's not accurate anymore. And it's not reasonable at this point to say 8/12 of the year is 166. Therefore, the whole year should be 250. That's not accurate given, June wasn't an anomaly. June was a ramp up to something else, something new, and maybe a new plateau. Maybe the plateau will keep, maybe it won't be a plateau. Maybe it'll be a 3-month plateau while they get the feel of running a company that's doing 80,000 kilograms a day or month, sorry. And then they'll learn how to do a bit more in Q4. Don't know. These are not projections. These are actuals. And so one way to do this, how big is this company? How fast is it growing? Is just to take the last month and multiply by 12. So if you believe they're at a new level, it was $55,000 for August. If you believe they'll repeat that or at least do that for the rest of the year, then we can say, and we do say this in the world of startups, that they have a $660,000 run rate. And that's the term we use, is run rate. Not revenues. They don't have 660,000 in revenues. We're not predicting 660,000 in revenues. We're not saying anything about 660 except that if you just took the last month times 12 or the last quarter times 4, that's what this number is. It's kind of a ballpark for where we think this company is going. And the question on the table here is, how fast are they growing? And so one quick, dirty back of the envelope calculation is, well, they were kind of doing 120 before, very hand wavy here, and now they're kind of doing 660. And so they kind of grew 5.5x in the last 3 months, more or less. And so we're kind of saying the 12 months, June to June, was 120-ish. And the 12 months, July to July, will be about 660 or better. So growth rate's about 5x, 5.5x, maybe 6x. We'll see if it keeps going. And when I see that, that pops out at me, and not just impressive, but scary high. So one thing I do warn all entrepreneurs is that growing is a lovely thing to do. Growing faster than 3x year over year is a really hard thing to do. It means you need 3 times more of everything. You need 3 times more people. It means you need more management. It is one way to get ahead of everything you need and spend more money than you should, because you got to hire all these people and get them up to speed, right? Basically saying that if you're tripling your employment, you're tripling your team in the course of a year, most people didn't work for your company last year, right? And not even barring turnover, most of the people who are going to work for your company in this triple time of expansion had no history in your company before, because you got to hire 3 times more people to serve 3 times more customers. Rare that maybe 2.5 times more people, or 2.75 times people. And it just becomes really hard to do. The culture breaks down, the processes break down. You just get more fire drills, and it gets less fun, right? Doubling is fun. Tripling is stressful. Growing 5 times, I can't really imagine what this entrepreneur is going through right now, because I haven't had one that grew that fast. And he's probably going to do 7x this year. That was just a warm up to get you to understand what the company is, because the second half of the call, and the reason why he wanted the office hours, was that an opportunity fell in his lap, and he didn't really have a framework to understand whether to take it or not. And so here's the opportunity. A new customer called and said they would like 1,750 packages of product delivered per day to this customer, and that they were willing to pay 15 cents per package. And the entrepreneur did a mental calculation and said, well, there's about 5 cents worth of product in those packages. And so that looked like, and he was all ready to jump on this with that much analysis. And I said, wait. Walk me through all this, and let's look at a few more numbers. So you're telling me it's 5 cents worth of stuff inside that package, but you got to pay for the package itself. And just be clear, this is a smaller package than they sell today. It's a different form and function. So there's a cost of buying that package that goes in. And then in order to do 1,750, you have to put them in cardboard boxes and put them in the back of the truck to ship. So there's a cost of like making cases and maybe wrapping the cases in plastic. And then there's a cost of just like putting this all together, and an extra cost of doing smaller packages and whatnot. And so first run, and these numbers are again kind of rounded, and we weren't doing this in dollars or pennies. it was in another currency. But more or less, first time we run through the numbers and he comes up with about 11 cents COGS, right, per package. And so with that, we can do some number crunching. And so that is 4 cents of profit per package. And again, he hadn't have his gross margins in his P&L, so he didn't have his gross margins in this analysis. I computed that, and that's really simple. It's 4 cents divided by 15, and you get 27. And so this is where I pulled up the P&L and I said, well, do you want to do a business that has half the margins of your current business? And that was an interesting conversation. So he hadn't realized that the opportunity was so less profitable than the product he was selling right now, right? It's actually the same product, different package, but than the packaging he was doing right now. He didn't understand it was vastly different, on the order of about half. So we talked about that, and what he said was, well, I kind of overestimated all those parts. So let's go back and compute it for real. And when we computed it for real, we got something around 9 cents for real. So it was really like 4.5 cents of product. And the package, we had rounded up, and so we rounded it back down. And we went to Alibaba and looked up what it cost and all that. And so it really was more like 6 cents of profit per package, which is 40% margins. And so first half a question here is, well, are we getting high enough that we want to do this business? So 27.5 margins, that seemed a pretty easy no. 40% starts to be in a gray zone of, well, do you want it or not? But that's not enough. I'm not going to make you choose on that. It took a bit to understand what the package was. So let's just call it 250 gram packages. At 250 gram packages, that's a quarter kilo. And so if we take 15 cents times 4, we get a price per kilogram. And these are all those snippets from that P&L. And so we can go back and look, and lo and behold, we're paid 65 cents a kilogram today, and they're going to pay us 60 cents a kilogram. So really the profitability is all about the packaging. It's not really about the sale price. We're pretty close to our sales price. And I said, can we go back to the customer and ask them for 16 cents per package? Because that would get us to our 65 cents or close to it, or 17 cents per package. Can we ask for a higher price? And so he went back, and the answer was no. But if you don't ask, it'll always be no. It was certainly worth asking, and it was certainly good to do this quick analysis to find out what it was per kilogram. Then we get back to bigger numbers. So let's just assume that they wanted this 28 days a month. Some Sundays off, whatever reason why it was not quite 30. But let's just say it was around 28 days a month. So we take 1,750 packages in a day. 28 days a month is 49,000 packages. We talked a bit about the fact that it's 49,000 packages. And then you just do the math on the numbers. So 49,000 times 15 cents is $7,350. So if this were January and this popped up, that would be something, because that would be almost doubling the business. If it was in the midst of the pandemic and this was a mitigation for the loss of revenues, this would have been great, because it would have been more than we made. But we're a business that's doing $55,000 a month now. And I pointed this out to the entrepreneur, and I did the quick math at 7,350 divided by 55,000. And it's roughly 13% of the business. And I said, well, is it going to take you more than 13% of your time to service this customer? Because remember, you're making smaller margins on them. So ideally, it's less than 13% of your time, and your staff's time, not your personal time. But is it going to take more than 10% of all the time in this company to package up 1,750 packages? And we didn't know, because we had never done this before. And so we kept looking. We did the same calculation based on kilograms. So it's 49,000 packages. They're a quarter kilogram each, which is 12,250 kilograms. So again, this entrepreneur knew what it felt like to do 12,500 kilograms in a month. That was the size of the company in January and February. But it's bigger now. They're doing 85,000 kilograms last month. That's 14%. So again, do you want to spend your time jumping on this opportunity to make 14% more money and flow 14% more goods through your business? Like, is there another way you could grow 15% bigger? Like, is it easier to just find one more customer for the current packaging than to do this? And then, of course, we can do this per year. So just take the 7,350 times 12, and you get $90,000, 89.5. And again, we don't know what the actual annual revenues are, but at this point, we can say that the run rate is about 660, and so this would be 13% of that. We could also make a rough calculation of what the annual revenues will probably end up with, and this would be, more of that because what we have is 166, and just assume another, 200 comes in the last 4 months, maybe 300. So maybe it's 20 something percent of that. And then we got to the non-quantitative questions. So I already mentioned the first one. How much time will it take to do this? What will you need to do this? What will it take to package up 1,700 packages per day? Is there a machine we can buy that will do that for us as opposed to just hiring a bunch of people? This is one thing that never pops up in the US. The answer is always buy the machine. In emerging markets, sometimes it's cheaper just to hire 10 people to do the work. You only have to pay the people a few dollars a day. So sometimes it's easier just to hire people to solve this problem. But, we went on Alibaba, looked at the machine, and it was like $20,000. So again, $20,000, we could, we'll make that profit in a year. We'll make it back in a year. So that seemed a reasonable thing to do. And then what it really boiled down to, which we had no idea on the call, was, is this the first opportunity like this? And there are more customers like this one that called us. This is an incoming call. Or is this the only one? Does this open up a new customer segment that we've just not been selling to? Is this our potential 5x growth opportunity in 2021? Does putting it in these 250 gram packages allow us to go and sell our product on retail shelves if we're not, either on different retail shelves or smaller retailers or any other customer segment? Is this really, the toehold and the beachhead to something bigger? Or is this just a one-off and we're going to spend 14% of our time fulfilling this one customer? And that's where we left it on the call. And so I will now open it up to you guys. And I would love to hear anybody who wants to chime in and provide your yes, no. And then I'm going to tell you what the fledgling said this morning. And then I'll tell you what happened.
Okay, so I have one more question that you didn't ask.
Okay.
And that was, would this opportunity cannibalize your current product?
Yeah. Okay. Yeah, I did. I believe I asked that on the call, but the answer was no.
Okay, good. Thanks.
I have a question about competition. Will the customer go to his competition, and will it cause the market fragment? Will we lose?
Yeah, we don't know. We didn't know then. We still don't know now. We don't really understand what's motivating the competition. We did find out this week the competition just got an investment, but we also found out they weren't paying their vendors. Their vendors came. The new opportunity that showed up this week for this company was that the vendors that are selling these kilograms of stuff called us and said, "Hey, your big competitor's not paying us anymore. Would you like our stuff?"
Huh.
Well, so we talked about that today, and then I knew the funder and reached out and haven't heard back yet. Life gets complicated, but let's just focus on the 250 gram product at the moment.
I guess my only concern then is you don't want to give any oxygen to the competitor by potentially giving them this customer. Yeah. I mean, I hate fractionalizing my focus, but
yeah, again, we're this particular market is humongous. We have 100x space to grow, and they have 100x space to grow. We don't need to fight over this customer. Yeah, could happen. I did ask, how long would the contract be for? But we're talking emerging markets. It doesn't really matter what we sign. They could stop paying us tomorrow. So are you a go or no go on this, Brian?
Probably no, if I don't have to worry about giving oxygen to competition.
Okay.
I mean, I don't know. I still don't understand how the overall market. You say that about 100 times to grow. Well, so why bother?
There are a ton of these markets out there where there's no local production. So competition is often an import, and we can outprice an import. That's not a problem.
I mean, the only thing is if if whatever this product is, if by delivering these, 49,000 grows the potential customer, end customer who eats it, because of this additional distribution, I don't know if that's the only thing
Yeah, we did talk about the actual package and, is there a more sustainable way to do it? And we talked a bit about that and there's some options there, but that wasn't our highest priority. Our highest priority was to figure out whether or not we should go in this direction and add this line item to our line.
Well, no, I'm just saying, will it increase their end customers who are buying these products from this other reseller? Will it, more people addicted to the product? So
no, there was no channel conflict. This was a totally new opportunity.
Okay, but I mean, does it grow their existing channel because more people have tried the product now? Because you got 49.
Not with their. I'll stop the recording at the end and tell you what the actual company is. But for this thing, no, it will not. It'll be no channel conflict, and no existing customer would likely also consume this in the other form.
Sounds like the competition is having some problems. I think you go back and offer it, but at a higher price. Go up to 16 or 17 cents, and if they don't take it, it's unlikely they're going to find somebody else to do it.
Yeah, it was I'm not sure they probably did go to that competitor first, but ultimately this is a nice to have for this customer. It's not a need to have. They could just ignore all of it and do what they're doing.
The basis that you think he's growing at 5% now, why are you adding this extra work?
True, not 5%, 5x. 5x.
Fivefold. He's growing.
He's bringing this opportunity to me. I'm just showing him how to analyze it and figuring out whether it mathematically makes sense.
Yes, but you already said it's very hard to maintain that rate of growth. So now I'm going to add this other thing.
Yeah.
That's very time consuming.
Potentially time consuming, but only 14% more income. Not 5x, not 2x. 14%.
I thought the analysis on the price per kilo was very revealing. It looks like his price is going down for a more complex product because it's smaller quantities. So he's hurting his own price level, and it probably will, and if anything, encourage more customers to buy the smaller package size. So I agree with Steve that I don't think he should sell it at that price.
Okay. That's a good way to look at it. Yeah. Anybody else?
Yeah, I don't think the margins are there. I mean, like you did that analysis compared to their current margins in the existing business, it's just not worth it. If there's so much more opportunity for that higher margin product, then that's what I would go for.
So what was really surprising was this morning when I did the same case with pretty much the same, it's exactly the same materials and more or less the same kind of questions. And we had, 15 entrepreneurs on the call, something like that. I think we had 1 no, 2 no's, and 13 yeses. That, entrepreneurs are not risk averse. They love it when an opportunity falls in their lap, and they were just drooling over, I can grow my business. Like, I don't care what the margins are, I can grow my business. And we talked about that a bit. And most of them are running on their guts, which is why I taught this to them, to get them out of their guts and onto the spreadsheets. But in the end, it comes down to I find this to be a very interesting case because it's not cut and dry. It's not an obvious no. It's definitely not an obvious yes. And what happened to the entrepreneur in this case was that he said, well, let's try it. So he bought, and I think it was only 1,500 in real life, but he bought like 1,500 containers. And he had his staff manually fill them up one day because, it takes a while to get a machine and that would cost money. And we don't have the money right now, or we don't have the money to hand him. So he just had his current staff fill up containers all day long. And no, it didn't take 14% of their time. It took all day and then some, right? First time through. So we don't know what it actually takes. But it took all day to get it out, and he got it out to the customer. And the customer did relent in the end and did, in fact, agree to pay the equivalent of 16 or 17 cents. So they did get us up to our price. The other reason why he did this was he turned to his salesperson and he said, call some other companies like that one. and see if they want it too. And so he called 6 and all 6 wanted it. And so then all of a sudden it's interesting. So then all of a sudden it wasn't this one customer, it was a whole new channel, right? A whole new sales channel, a whole new customer segment at a reasonable price. And yes, the margins were a little lower because of the cost of packaging, but not terribly low. And once we get a machine, we expect the time sync will come down. And with 6 times more customers, again, yes, Verna, you're right. This will stress him out, but this is an opportunity this is likely the path to double the company again. And this is a company that is literally going from $120,000 of revenue last 12 months, to something around 400,000 or 500,000 this year, 600,000, 700,000, 800,000 next year without this opportunity. This is the path to get them up into the $1 million range. And once they do this channel, then the retail sales become a pretty obvious one to go next. So in the end, at the moment, the answer is yes. But until that machine gets purchased and brought in and whatnot, it could turn into no at any time.